Modern portfolio theory, or MPT, has its limitations. And here to talk with us about this is Tony Davidow, author of the forthcoming book, Goals-Based Investing. Tony, welcome.
Thanks for having me, Bob.
Tony, it's always a pleasure. Your book is about to be published, but you've written this blog that sort of gives us a highlight, a little snippet of what's in the book about the challenges of modern portfolio theory.
Yeah, and I think modern portfolio theory has served us well for decades. Modern portfolio theory in its simplest form suggested you could take two individually risky investments, and if they don't move in lockstep with one another, you could combine them in such a way to actually provide a smoother ride over time. And I think that started as a basic sort of premise, and it evolved to something that we often refer to as the 60-40 portfolio. If we had stocks and bonds, which don't move in lockstep with one another, would we in fact have some balance in our portfolio? And would this in fact be a good way of solving for investor needs over time?
Right. So one of the things that Markowitz promoted was the notion of this value of diversification, which goodness, he created this theory back in the 1950s. It's evolved a lot since then, this notion of 60-40 portfolios, asset allocation.
Yeah, it really has. And, I've had the good fortune of actually spending a fair amount of time with Harry Markowitz. And I think Harry would admit, what he presented at that point in time was very provocative, right? Because it's the first time that we actually thought about investments as being part of a portfolio. But the toolkit that he was looking at that point in time was stocks and bonds. It was a pretty simple world. Stocks and bonds tended to move in opposite directions because there are different stages of financial development. But I think as we fast forward and we look at today's world, which is so much more interconnected, it's not enough to have exposure to stocks. You have to have exposure to U.S. stocks and international stocks and emerging market stocks. Your fixed income exposure needs to be more broadly diversified. And I think one of the things where I challenge modern portfolio a little bit is we need to expand the toolbox to include things like alternative investments.
Right. So, I mean, in some ways, Markowitz had it right in the sense that there might be an optimal portfolio for a person given their risk tolerance or risk aversion. Is that still true today when you think about adding all these asset classes?
Yeah, I would say, I think the value of diversification is still there, but I think there's a couple things that we need to just recognize. One is modern portfolio theory, like a lot of financial theory, is mathematically driven. And the assumption is that investors are rational and they will always select the optimal portfolio. They will present the portfolio, they will select the portfolio that provides them with the greatest likelihood of achieving a desired outcome. Well, the reality is we all know that investors, and even you and me, Bob, are emotional, and we often don't act rationally. In fact, we don't act rationally when we need to act the most rationally, right? It's the fear and the exuberance that often drives our behavior. So the basic premise still makes an awful lot of sense, but I think we need to recognize there's some limitations in it.
Right. And of course, by adding all these new types of investments, whether it's hedge funds or private equity or whatnot, I mean, it does take a level of knowledge to understand what it is that you're adding and why you're adding it.
And I think that's the most important thing. And again, not to promote my book, but I think part of the reason I wrote the book is I felt like there was a real need in the market to better educate advisors and investors about what are these individual investments solving for. And Bob, as you know, I often use a kind of a very simple puzzle piece analogy, and I try to break down all investments individually to say, what are they solving for? So I'll mention one other quick limitation with modern portfolio theory, and that is that it assumes that risk, return, and correlation, right, the interconnectivity of asset classes, is a constant. But what if they're not? And in fact, the market environment we see today, we're actually anticipating lower returns. We all know that we live in an environment with generationally low yield. Correlations, the interconnectivity has been increasing because of the way the markets and information flows. And the last sort of dynamic we need to solve for is inflation, something that you and I recall well. But many younger investors have really never been exposed to inflation. So to me, when I think about it, I try to think about, of the underlying investments that I'm considering for my portfolio, what role do they play? Are they there to provide incremental return? That's the role and the value of private equity. Private equity has historically outperformed traditional equities. I'm getting my incremental return there. If I'm looking for enhanced yield, because I know yield in traditional investments are very low, I might want to consider things like real estate or private credit. If I want to dampen the volatility, that's the role that hedge funds provide, right? Hedge funds provide this non-correlating assets because they can be long and short the market. And then if I want to think about how do I hedge against the impact of inflation, I think that's the role of a lot of real assets can play in your portfolio. So if we start to break the investments into their simplest form, what do they solve for? We can then more intelligently think about how do the pieces of the puzzle come together.
Right. So goals-based investing has become a mainstream response to the limitations of MPT. But before I ask you to elaborate on that, I would love for you to define for our viewers mean variance optimization, because it's in the blog, but it's also a term of art that people may have been exposed to, but may not quite understand.
Yeah, it's like all models. Models are dependent on the inputs. Mean variance optimization, or sometimes people just use the short form MVO and assume that everyone understands it. It's similar to the discussion, Bob, you and I have had about Monte Carlo. They're actually very valuable tools, but you have to understand the limitations. So mean variance optimization models essentially are taking the inputs and primarily the historical returns of stocks, bonds, and whatever sort of other asset classes we add in there. And the three really drivers of the outcomes are risk, return, and correlation. And what mean variance optimization models really like are non-correlating or low correlating assets. It will actually allocate more to assets because what we're solving for is what's the optimal combination of asset classes. And if we can identify low correlating assets, they help buffer the volatility and you get the positive compounding of return over time. So again, assuming that risk, return, and correlation are constant, it's a great tool. But if they're not constant, and in fact, what we're looking at, if we look at capital market assumptions, we're anticipating substantially lower returns, substantially lower yield, and higher correlations than we've had in the past, it's kind of a bad math problem. Right. So if we use stale data, much like we do, as we discussed with Monte Carlo, we're likely going to have a different outcome and clients are going to be disappointed. So to me, I would challenge anyone who uses these tools is one, understand the limitations of the tool. And two, I would strongly encourage using forward-looking capital market assumptions, something that's a little bit more realistic given the market environment that we're in. Otherwise, we're potentially exposing clients to either too much risk or putting them in a situation where they're not going to meet their retirement income in the long run.
So let's turn our attention to goals-based investing and how it's become the response to the limitations of MPT.
Yeah, I think it is kind of the natural sort of evolution of it. So modern portfolio theory, and again, you made an excellent point earlier that diversification still makes sense, but MPT has these limitations because and the biggest limitation being the assumption that the rational investor will always choose the right portfolio for them, when in fact, what we really understand is we're all emotional and we're all driven by behavioral biases, and we have a tendency to chase performance, right? We chase the hot performing asset class, we chase the hot performing fund manager. And behavioral finance, while it recognizes some of these limitations and these behavioral elements, really doesn't help us in solve for it. It just says, hey, we've got problems because we respond to emotional stimuli. Goals-based investing, in my view, changes the dialogue and changes the utility function. So what we're really solving for is what are individuals and their families trying to solve for over the long run. Typically, we're not thinking about, I want to outperform the market. But unfortunately, when we think about our portfolio and we hire a financial advisor, we're often looking at how did the Dow do and how did the S&P do, rather than what we should be saying is, how am I doing relative to my plan? How am I doing relative to my retirement plan that I've established, which has a 20-year time horizon, and I'm thinking about generating a 6 to 7% return over time? If we can get people oriented to think about, do I have the right strategy in place that gets me to where I need to be over the long run, rather than outperforming the market, we'll all be better off in the long run. And of course, that doesn't assume that we're not going to make adjustments along the way. We all make adjustments, right? Our financial circumstances change, our family changes. We have a new grandchild or something that causes us to change it. But if we can condition people to think about long-term, what are we solving for? What specific goal is it that we're trying to solve for this pool of money? I think we'll all be better off.
Yeah. Tony, what's so interesting is when folks are looking to hire an advisor, sometimes the question they ask is, how has your portfolio done against whatever, the S&P 500 or a 60/40, composite? When the real question should be, how have you met or exceeded your clients' goals? Did they achieve the objectives that they were trying to reach, or not? And that seems to be like the more appropriate question when you're betting an FA. It might be a little bit harder, but nonetheless, it seems like that's the real question of whether the advisor is delivering value. Are they meeting their clients' goals?
I agree 100%. And I think sometimes advisors fall into that trap too of saying, my value is outperforming the market. That's not the advisor's value. The advisor's value is helping their clients achieve their goals, dreams, and aspirations. How they do that might be through the portfolio, but it's not just the portfolio, right? It's taxes, it's trust and estate issues, it's retirement planning. And if all the advisor is focused on is outperforming the market, they're likely exposing clients to too much risk. They may erode any benefit that they get through, inefficient tax allocation and all sorts of issues. So to me, you're exactly right. The value of an advisor is to help clients achieve their goals over the long run. Goals-based investing memorializes that. And often, especially for larger families, there may be multiple goals that individual advisor or the family themselves are solving for over time, with different time horizons and different underlying composition, because there's different things that we want to achieve with our underlying pools of money.
Yeah. So we covered a lot of ground. Anything that we missed or anything that needs to be reemphasized?
No, I think, as always, Bob, you do a great job kind of leading me down the path. The one thing I would do is I'd go back to one of your comments, which I think is important to recognize. Modern portfolio theory served us very well for a very long period of time. And there's a lot of great lessons from that. And the most important, of course, being diversification. It's just we need to recognize the world is different today. And I really view this as more of an evolution as opposed to a revolution where we're, getting rid of all the things that we've learned in the past. I just think we need to grow and evolve. And the more that we can think of that as an evolutionary process, it makes it easier in the future as we start to introduce different sort of asset classes.